Hello chums! Welcome back to Economica, all about economics. And yesterday we have a special episode about the UK economy. And because back in my previous video I was trying to explain the nuances of the Taylor rule formula and how I was thinking around the Taylor rule formula and all its variables according to my knowledge, and how I would set the Taylor rule formula, which variables I would use, and which sort of how I would derive the parameters that I would utilize to calculate an arithmetic formula, which is the Taylor rule. And as I said back in my previous video, that I had to refine my thinking, and I've done a little bit more work. So let's get on, chums, with today's episode. And because also if I believe the spring statement it's coming, and so I'll try to give you a perspective of the possible forecasts of the UK economy, which is not it's as uncertain as a weather forecast. The sun is shining and spring is coming, and we will all have a beautiful spring and summer, plentiful of joy and peace, and humanity and the world will be calm and without any sorts of diabolic issues as wars and stuff like that. So let's hope for the good for everybody involved in the peace of the planet. So, as I said, I can provide you with a better informing macroeconomic forecast of the variables that I studied back in my previous video, which is a VECM model. So it's a vector error correction model. So as you are all well versed, when we talk about vectors, then we have to think about matrices and how. So when we take a bunch of macroeconomic variables, so we basically each of these variable is treated as a vector, and then the interpolation or the mathematical workings of the vector error correction model works through matrices, okay, because a series of column vectors, they define a matrix with matrices with full rank, and if it's determinant, if it's invertible, and you find the eigenvalues, the eigenvectors. And so when you find the eigenvalues, you can do, for example, you can ask the machine, what is var stable, and it will tell you, okay, all the values of the var model, they all are within the eigen values of so they are all within a certain range. So the var model, it's a vector autoregressive model, so it basically works as an ARIMA model. It does autoregression with its lag terms. The method that I'm showing you today is the VECM, is the vector error correction model. So still works with matrices and with vectors, but it's I believe is more precise than a VAR model. Because it works, it interpolates the variables, and it tries to find how the variables they correct their overshoot or undershoot in relation to the other macroeconomic variables that you have injected into the models. And I found that the forecast charts that we will see now together, they are much more precise. And the VCM model carries also a wealth of additional information which are very useful to understand the parameters, the forecast, and it shows you also the theoretical, not the theoretical, what are the resulting error when implementing all the model. So, okay. First thing first, we have here some sort of 19 variables. We will count it now together. And okay, what do we have here? It's the CPIH, which is the Consumer Price Index, including households and owners, occupiers, equivalent rent. So like households or people who are renting the property. So it's a CPI, it's an inflation basket that includes also the cost of shelter. Okay. And the forecast is for a slight decline and stabilizing around 3.5%. The GDP, real GDP forecast is a bit choppy, but we see that the long run average growth quarter on quarter of UK real GDP, and I want to emphasize it's quarter on quarter, it's not year on year GDP. It's always been around 0.5%. Okay, and before you start with all comments, chance it's good, it's bad, it's flatlining. I am compared it with other countries in the world, so I don't work with this assumption of prejudging stuff. I'm telling you what is the data. Since 1950 up to now, the average growth per quarter it's 0.5%. More than half a point, less than half a point, but on average we are around that stuff. So we have to be realistic when it's useful. It's very, very useful when we see the data, so that we have a cold shower of reality of what actually is the potential, and what is the size of the engine, and how fast the economy can grow. Because like plucking words out of the air, superpower, we will have the fastest growth in the world, it means that it's a pipe dream. I think it's much better to be more realistic and see what is the data. If you actually have wasted a bit of time to actually look at the real data, the historical time series, and then did you have a theoretical and an empirical framework which is consistent and based on real facts, okay, not like a superpower of, I don't know, pie in the sky. So as you all can see, the forecast of the GDP just only on a percentage variance. This is not by no means all the inflows and outflows of capitals, the accounts, that's another stuff. But anyway, it's very flat, and some quarters they are projected to be negative. Okay, so not great. Net debt to GDP is projected to increase. You can see here the forecast net debt to GDP, including banks, it's projected to increase to 110%, like 2020 levels. Employment rate is projected to be steady and a little bit less than the steady rate now, which is 75%. Maybe it will be 74 and change, 74 and 6, 74.5. We are around small decimals. The budget deficit is projected to increase, and its budget deficit, they are very cyclical. The unemployment rate, this is very crucial, is projected to also to go higher to 4.5, 4.7, 4.8%. Right, seems that the machine got some sort of seizure or some sort of panic. So what happens? Okay, let's go on. I will make sure that the video won't come out with this panic. Okay. Anyway, I was saying the unemployment rate is, as you all can see, is projected to go up. okay, and is consistent with the decline in employment rate. Output per worker, it follows more or less the long-term trend, which is more or less sometimes is negative, sometimes is positive, but we are around small percentages around flat zero. RPI, it's projected to decline, which is strange enough for me, but nevertheless it will be converging to 2%, 2 and something, but anyway. Productivity per jobs also seems to decline in the first period and then be a bit choppy to stabilize around 0.5, but you can see all the range here is between 0 and 0.5, so we are talking about very small percentages. CPI excluding tobacco, I will this one is the data it's not good, so don't bother with that. Business investments also follow the historical trend of the in the UK economy, so it should be a bit higher business investment quarter on quarter and then just stabilizing with a sort of cyclicality. Total assets seem to be a bit negative percentage in starting and then some sort of positive backup, still with cyclicality, because the creation of productive assets in the economy takes a bit of time to build anything that is productive, but we are in a narrow range, nothing spectacular. Same is for the general government, the government spending and the creation of assets. We are in a small contraction in the first periods of 2025 and then around the long-term trend. Business investment seems strange, not strange, but very good forecast. Like I think because these are out of sample forecasts, so the forecast is an out of sample projection, because the sample is the historical data. This is the sample of data which already have happened. So the machine projects an out of sample forecast, and the historical data, they are business investment is 0. And maybe you would think, okay, maybe it will be negative. The forecast of the machine, it's here, the line plugs up here, but it then follows more or less what is the historical trend. So we will see in a moment the table with numbers, so there will be more precision. Okay, I believe, yeah, this is another example of the government spending, and this will be all retail sales on a weekly basis, including fuel on a year-on-year percentage change, and they will be more or less in line with the historical trends. Assets year-on-year, like a sort of decline, and then stabilization around historical trends or cyclicality. Same for retail sales. And yes, here we have at current prices we have a more narrow range of retail sales forecast. Nevertheless, it's positive, would be around 2-3% or something like that. And crucially, the Bank of England the past week kept the sterling overnight rate unchanged, and the out of sample forecast is for a decline in long term to 4%, so nothing spectacular, or a decline like a cutting of interest rates, so a lessening of the pressure of borrowing costs to 4%, and so it still will be somewhat of high interest rate. It's not like the machine doesn't go to 2 to 3 or to 2.5, so I do expect that the Bank of England have imposed now, at the best it can do two interest rates base cuts of 0.25 basis points, so from 4.5 it will move to 4%, if I have to follow exactly what the out of sample machine forecasts give me. These are the retail sales. Okay, so to show you the actual because I have a lot of interesting data, a lot of interesting things, and I can help you all understand some very important things for those that are more versed into the nitty-gritty of economics. For those who are less familiar with the terminology and the language of macroeconomics, don't worry, I'll try to be as explicative and concise as possible. So you can all see we have the forecast results, and allow me to set the characters to 16, so we will have a larger, without doing any disaster. Bear with me, champs, bear with me, bear with champs, bear with. Okay, so you can see the forecast goes well into 2027, the second quarter of 2027. That's why I appreciate a lot the VECM model. And as for the chart, the out of sample forecast is for the CPIH annual rate to be at around 3% by the end of Q1, 2.9% by the end of Q2, 2.6%. I'm sorry, 2.9% at the beginning of Q2. That would be 2.6%, 2.7% at the beginning of Q3. And by the end of 2025, CPIH should be around 2.5%. To then, you see that there is an upward trend for CPIH to just basically drift back up to 2.67, 2.72, 2.87, and so the machine sees a CPIH back to 3% in 2026-2027. So the trajectory, it's a very steady and gradual, sweet decline, decreasing of the inflation rate for 2025, and then the curve will bottom at 2.5 and then will steepen up again. As I was saying, the real GDP is projected to be negative, minus 0.87% in the first quarter, positive for the second quarter, slightly positive for the third quarter, and minus 1% in the fourth quarter. Now, if we take a calculator and we try to help the people which are less intelligible with the use of scientific calculators, and we try to see what is the sum of the quarter on quarter to have an idea. Plus 0.33 minus 1, so it's negative 0.17. If I divide by 4, it's basically still would be negative GDP on a yearly basis. So the macroeconomic projection quarter on quarter for 2025 still it's of more or less a flat to a marginally negative growth, like a shrinking of real GDP, although nominal GDP can still be growing, like so not everything is so gloomy and doomy. And 2026 also the machine has some sort of hiccup in the second quarter, but the projection are for moderate growth of 0.2, 0.6, 0.4%, which are in line with the average quarter-on-quarter, historical average quarter-on-quarter growth of real GDP for the UK economy. Crucially, net public debt is projected to rise, and we see that it's projected to be 104% for the first quarter of 2025, even 110%, and then gradually stabilize around 107, 108%. So this is very important, and we see why we can appreciate why net debt to GDP is projected to increase, because the budget deficit projected for Q1 it's 1.5%. So the economy, the deficit will be growing 1.5%. At the same time, the machine projects out of sample that real GDP would not even be positive but negative. So that will be a double whammy. You will have a net deficit on top of negative growth, so that adds a lot of net debt to the overall stock of debt. But if we all confront the two columns, we can see that the machine, after analyzing what is the cyclical historical data of the budget deficit, quarter on quarter it projects a steady 1.5, 1.1, 0.70, 0.76, 70 or 0.8. You can see here 0.97. So in aggregate, the average budget deficit is of 1% or a little bit more, while if we confront with the GDP column, we see that on average the growth is of 0 point something. So net budget deficit the machine projects that budget deficit is always growing more than real GDP. Then what is the difference of growth between the deficit and the GDP? Then it's cumulated, it adds up to the stock of debt. Okay, it accrues into debt. You can use the ratio between what is the deficit to GDP, but that's the ratio is debt to GDP. Then to see what is the difference between the deficit and GDP, it's just doing a subtraction, and you find out if the debt has grown, if deficit has grown more than GDP, or real GDP has grown more than budget deficit. In that case, you have deficit which is growing faster than GDP, and that figure then goes to into the numerator of the ratio debt GDP ratio. Okay, if the numerator is growing and the denominator is growing less than the numerator, then you have a higher debt to GDP ratio. And so that's why the machine is very precise in this instance. Output per worker, it's very it would be 0.35 in the first quarter, negative in the second quarter, negative in the third quarter of 2025, negative in the fourth quarter. So I don't have a particular or precise explanation. All I can see is the forecast, and it also tells me that after the machine going through all the historical data, what is the projection? The output per worker, first of all, is not it doesn't seem to me to have a clear trend, but it's choppy, it's somewhat volatile. You don't have a steady positive output per worker, and the forecast of many quarters with negative output, it seems to me that it's related. If you go and check my previous video, then it's related to the lack of productivity or the low productivity, which is intrinsic is a structural feature of the UK economy. If I would summarize on an historical basis from 1950 up to now, what are the two idiosyncratic factors of the UK economy is persistent and structural high inflation, which is structurally higher than the 2% Holy Grail threshold, and some sort of volatile productivity that depends on business cycles and what is the overall structure of the economy. For example, in the 1950s, 60s, 70s up to the 1980s, the output per worker of the productivity per jobs was much higher. You had the productivity per worker which was 1% or more than 1% per quarter. Then after the 1980s, you have the transformation of the economy into a mostly services driven economy, and so the output per worker tends to decrease. And after the financial crisis or after the year 2000, you have negative output per worker. So you have less and less a trend of decreasing productivity, of decreasing workforce or labor productivity. That is due to many factors, but one important factor is inflation, which is inflation. It's a cost for business and a cost for the worker that has then, with the disposable income, it has to be able to provide for himself and for the family. So nevertheless, employment rate, as I said, the graph shows is a marginal from 74.8 to 74.7, so a slow decline, and at the same time you have an uptick in the unemployment rate that is from 4.4 base going up to 4.5, 4.6%. So very marginal variance in the forecast for the unemployment rate, which nevertheless will go up. And this also justifies somewhat of lower productivity. So the output per worker, it's steadily negative in the first year, and it's volatile also for the other quarters in 2026 and 2027. So we have 4 quarters here, 2025 and 2026. First quarter will be should be strongly positive, second quarter as well, then a sort of hiccup in the third quarter, and then strong quarter of productivity in Q4 2026, and then again the cycle reverses and you have a marginally slower output per worker in the first quarter of 2027, and then back on average some sort. So the machine does a good work per se, and it tells me that there is volatility in the output per worker, while instead you can see here, you can confront with productivity per jobs in the whole economy, and you see that there is an average which is steady. It's 0.3 or 0.4, 0.2, 0.4, 0.5%. So we are in an average range which goes between 0.3 or 4 to 0.5%. I will have to do a quick average, so that you can see how to work with the calculator if you are such a big mouth and then you cannot use a calculator. K plus, I say plus 0.475, we got it, 0.444 plus 0.49. Bear with me, chums, we will see. I want to see exactly what is the average, and we divide by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, 10. Yeah, 0.425, 0.42 and a half. So we see here, we confront with output per worker, we see that productivity, all jobs, per jobs in the whole economy, the machine has a forecast of an average 0.42% and a half. Okay, 0.42. Okay, 0.4. The output per worker seems to be on average a bit skewed to the negative side, but it's very volatile. So it depends on how these statistics, these data are measured and they are compiled. Nevertheless, going forward, RPI also is projected to decrease, but then to go back up again to the same average level, 2.5, declining to even 1.5, 1.8, and then drifting back up in 2026 and 2027 to 2.3, 2.4%. This CPI, I cannot consider it. So business investment, we see the volatility of business investment, plus 5.5% in Q1, minus 5.7% Q2, plus 1.4% Q3, minus 0.93, minus 1. So these are all projections. Minus 1, it's Q1 2026. So the machine goes a bit forward in time. But nevertheless, you can see there is plus or minus, and this reflects the cyclicality and the volatility in the business cycle. okay? And so the volatility of business cycle, it depends also from structural higher inflation and structural volatility in the productivity of inputs in the economy, which can be businesses, which can be infrastructure, which can be the workforce. So general government quarter on quarter, it seems to be mostly this general government creation of assets, of new assets, seems to be quite negative in the first quarters. So we have some mixed projection, which reflects the volatility and the cyclicality of the business cycle. Total sector assets are negative for all 4 quarters of 2025, and I can confirm you that there are some tables from the Bank of England with which have showed me that actually, in terms of gross fixed capital formation in the economy, whether it is according to the economic sector, the sector of the economy, which can be, I don't know, transport, restaurants, industries, manufacturing, services. There is a table in the Bank of England latest table that bear with me, James, I will show you now. It shows me that capital formation, there is no issuance of commercial paper, and yeah, you can see it now. Okay, I will try to so numbers are very tiny. Okay, let's try to do a better job with this. Oh dear, I pretended too much. No, okay, let's keep it for what is supposed to be. Okay, so now I've done a disaster, but it was better the original thing. So you can see a net capital issuance by UK residents by industry, and it's not seasonally adjusted, so it's not discounted for inflation. And you see here that 2023 and 2024 you have a negative issuance, whether it's mining, electricity, gas and water supplies. So the total issuance, but you see many months which is negative issuance of capital, of money. So the issuance of money, it can be commercial paper, it can be corporate bonds, it can be some sort of line of credits for businesses, senior, I don't know, all sorts of things. But I mean, I hope you understand. You see the data. It's a construction. It's a contraction of credit in the economy, of private credit in the economy. Wholesale trades, so negative, totally negative. The total is positive here, but many months of negative credit creation. Hotel and restaurants, minus 3 million. But you can see here, this is the aggregate, the total, the end sum. But you see many months of minus 130 million, minus 200, minus 300 million, like in September 2023, you have minus 300 million of issuance. So it's probably, I don't know, I mean, it seems to me a negative number. It seems to me that there is no issuance of money. There is no private credit. And so all the real estate, a billion negative figure here, and there is minus 2.5. I hope I'm not wrong. I'm not reading wrongly the data. Like business activities, we have a positive, but the total for all these this industrial sector, it's minus 1.19 or minus 1.2 billion, a billion and 200 million, 1.2 billion negative. So it seems to me a contraction of private credit in the economy that has been going on in 2023, 2024, because that's the only thing that we can see now. While it's a monetary financial institution, they have a positive balance. Other financial corporations, they have a positive balance. So the total overall, it's 11.7 billion of net capital issuance. But the bulk of credit creation is either monetary financial institution, which is banks, or other financial corporation. So I understand this is a table from the Bank of England, so it's related to the issuance of corporate bonds from banks or these sorts of it's more skewed to the banking sector, but nevertheless it shows you a picture that the other parts of the economy, the overall aggregate of the economy, which basically works on real things, on producing, I don't know, meals, hotel and restaurants, construction, utilities, electricity, water, gas supply, mining, agriculture, there is no credit creation. There is some sort of contraction in private credit, and that's a consequence, or it's an outcome of a bad economic environment, and also the cost of borrowing, which is which is correlated with inflation. Okay, so a big issue of the UK economy, like the baba in the room, not the elephant. What is the baba, the savarin in the room? It's inflation. I come to the conclusion that inflation is a huge problem for the UK economy. So business investment, total sectors, that's why the machine projects all negative percentages quarter on quarter, because if we account for the total for all the sectors in the economy, and we confront it with the negative of private credit, there is no issuance of new capital, of new money, even in the private sector, for all the parts of the economy, then of course there is no creation of assets. Business investments seems to be very positive in Q1, plus 14.5%. I don't know from where this number comes, and it's mostly positive, not for Q1 2026, but although the machine has a positive picture of business investment, this is another iteration of general government creation of assets, and it's slightly different. It's a positive, on average seems to me a positive, but I should do the exact calculation, but it's mixed, let's say. It reflects the cyclicality. These assets in other iteration, it's less gloomy than also because it's a different time series, and because this is quarter on quarter on a year basis, this is quarter on quarter, so it's different frequencies of data, and nevertheless it's for 2025 still it's a mixed picture. First quarter very positive, in line with business investment. I don't know, the machine projects a strong Q1 investment, I don't know, and then negative for the Q2, Q3, Q4 2025, and then on average 1.2, 2.7, between 1.2 and 2.5, 2.7%. So then for what regards retail sales, we see that we have strong numbers, between 2 and 3% for each quarters. These are excluding fuel, so still on average between 1 and 2%, projected quarters 2025, 26, up to Q2 2027, and all retail sales figures seem to be positive. And last but not least, we have the sterling overnight, which is projected to decline by 50 basis points from 4.5 to 4%. So what is interesting for the VECM model is that we can measure, where we are now here. We are far and away from, so let's stick with the code. We can measure, I will not go through the lags because it's gonna take too long time, and I want you to focus on the next topic, which is the work that I have worked on, the Taylor rule. So you see here the alpha coefficient. So this tells you basically for first variable, the CPI-H, it tells you, okay, this is the coefficient, you have a p-value which is statistically relevant. What tells me that CPI-H tends to adjust, to correct its overshoot by this coefficient, which is minus 0.10%. Okay, and so does for all the variables that you inject into the model. So GDP, it does not have a nevertheless it tends to adjust by this small coefficient. P-value of net debt tends to adjust by this coefficient. So net debt, when it deviates from its long-term trend, or there is a shock in net debt, it tends to adjust positively, so upward, with a 0.17%. Okay, so that's what does also the VECM. It tells you what is the coefficients of adjustment that each variables has showed during its historical time series data. Okay, banks. So you see that the coefficients of adjustment are all very small percentages, but nevertheless this helps you to understand how the variables, how they adjust into the economy, when they overshoot or they undershoot, where they drift higher or lower from the long-term trend, and how they adjust, how the variable adjusts within each other in the economy, all the moving parts. Like this p-value is very relevant, and it's output per worker, and tells me the output per worker tends to adjust by minus 1.15% to the negative side. So output per worker, this statistic which is collected by the ONS, it tends to adjust negatively. It has a negative skew, and it tells me the output per worker tends to be negative. I don't know why. RPI also tends to adjust negatively if there is an inflationary shock. So general government quarter-on-quarter creation of asset tends to adjust also to the downside by minus 1.12%, and this is the business investment. Instead is a positive adjustment by 4.3%. So this is the alpha coefficient, which tells the adjustment of each variable. And then you have the beta cointegration factors, which is the cointegration relation between variables. Beta 1 is CPI, beta 2, etc., etc., etc. And then you have a coefficient of adjustment, which is worked out from the interpolation of the variables. And if we check the p-value column, only beta 9, it's too large of a p-value. So all the variables that we have considered into the VECM model, they have a relevant beta factor. So their cointegration it shows a very strong relation between these variables, and then they adjust by some small or very large coefficients within each other. So if inflation is moving, then GDP will adjust by a coefficient within the cointegration matrices, which is also very interesting. And at the end of the prosopopea, we have also the root mean square error, and the RMSE shows you what is the mean square error for each variable. The smaller is the error, the more accurate is the forecast. Okay, so some like CPIH has a somewhat of large root mean square error, also net debt, because there's some sort of cyclicality or things like that. Some RPI, small values, they show you a smaller error. Okay, also this one, you see how large is the error here. So of course we have to be attentive and careful in what we see from the data. So back to us again, to the Taylor rule. So as I said in my previous video, I have been wondering about the Taylor rule, and I've explained the other day that I'll flip around with this one so I can write something on the free paper here. Okay, I've explained the Taylor rule. I repeated that the Taylor rule is a neutral level of interest rate plus a actual level of inflation plus alpha and inflation at time t minus the 2% target plus beta and the GDP now minus the potential GDP, and this whole arithmetic equation will give you an IR, which is the optimal interest rate for the economy. And if there is an inflation gap, so inflation is higher than 2%, you have a positive inflation gap. That means that you need to, arithmetically by the formula, you need to raise interest rate. So my changes to the formula are that so alpha and beta usually are equal to 0.5. Although, for example, John Taylor said that alpha parameter, because it's related to the inflation gap, it should be 1. What that means is that for every percentage point of positive inflation gap, I will jack up the 1-to-1 the interest rate, okay? Because it's very natural. If here, instead of 1, I persist in having 0.5, when I multiply 1, which is the positive inflation gap, with 0.5, I end up with 0.5 in the final result of the interest rate. But because I want to be in line with what is the inflation, the deviation of the inflation gap, then I want to be sure, for example, that I move the interest rate up 1-to-1 with inflation gap. And then, for example, beta, you can leave it per se at 0.5, so you want to be more gentle with the output gap, which is more normally distributed. So the work that I performed is to refine the formality of the Taylor rule by doing what? By doing a lot of work, a lot of research, and refining. Still I have unanswered question that oh, this doesn't want to cancel. Anyway, come on. Okay, you need to say come on. So first thing first, I substitute alpha and beta with the conditional volatility of inflation, the average conditional volatility of inflation, according to what GARCH model fits the most among these 4 GARCH models, plus the historical conditional volatility, the average historical conditional volatility of the output gap. Then I studied in isolation the inflation and the output gap with the CLT, the Central Limit Theorem, and I have standardized the inflation gap and the output gap. By standardizing the inflation gap and the output gap, I have empirically proved to myself, and I will show it to you, I will prove it to you, that inflation is not normally distributed, and it's not symmetric to 0. The raw number, I mean, the inflation data, they are not symmetric to 0. It's not a standard normal distribution. It deviates. It depends from country to country. So I say it again, I use the CLT, the Central Limit Theorem, to standardize inflation. Because inflation is not normally distributed, and I want to achieve a theoretical and empirical framework of the Taylor rule, which gives me more certainty and injects into the equation the long-term variability of the conditional volatility of inflation instead of a fixed parameter, like a 1-to-1, 1% inflation, 1% up interest rate. Central Limit Theorem, I work this formula and I use pi bar. So I take the time series of inflation and I find the average. Then I set mu pi, which is the sample mean, sorry about that. And then I standardize by doing this, square root of n, okay, or sigma square root of n. And n, it's, for example, 144 for the quarterly inflation data time series that I have for the UK inflation data. And the same method, I used it for, I have y t bar minus mu y of t, and then I have sigma square root of n, okay, sort of central limit theorem. So why do we do this? Because I want to have a distribution, a standardized distribution of outcomes, or standardized distribution that shows me the range of the inflation output and the inflation gap and the potential output gap, so that I work out all the historical time series, and by using CLT I can standardize the gap, mind the gap. I can standardize the inflation gap and the output gap and see what is their distribution, and because it's standardized, it's skewed around 0. It's skewed, it's centered around 0. I don't know if it's visible. Yeah, okay. So you see here the distribution of the output gap with CLT, you see it's centered around 0. So it's a standard normal distribution. If I take the raw data of inflation and I don't standardize the data, inflation data, then I have a bit of a problem, because inflation is not symmetric to 2%. And I will show you now here. Okay. If I take the Excel, you see here observation date Q1 1989, and there is two frequencies, quarter and month. Okay, and the other column is inflation gap. Okay, I'll make it larger so that you can all read it. Observation date, CPIH monthly, month inflation gap, quarter on quarter inflation gap. Most of the inflation gap, they are all positive. So there are two important things to know at this point. As you can see, the bars of this CPIH quarter on quarter, so these are these two charts. Okay, they reflect, with the bar chart, histogram chart, they reflect the inflation data that have been recorded quarter on quarter since 1989 Q1, or since January 1989, month on month. So a standard normal distribution is this one. You see here, it's centered around 0 and is a standard normal. It's symmetric, 5 minus 5. Okay, and the textbook standard normal, it's n approximately 0, 1. So it's centered around 0 and it's plus 1 minus 1 standard deviation. Okay, so remember the shape of this, it's a bell curve. Yeah, it's a bell curve, right? It's symmetric. If we see the bar, we see that we have a lot of values going up to 0.7, 8, 10, which means 10%, 9%, 8%, 7%. So the distribution of the inflation data, it's not symmetric to 0. You see here. So only the month-on-month inflation is more or less symmetric to 0, more or less, but it's positively skewed. The quarter-on-quarter is symmetric. It's symmetric, or it's centered around 2%, just to pleasure all the central bankers, which they work with the wrong assumption, the wrong empirical model. But because all the bars they go higher and higher and higher, here you don't have a bell curve, but you have a chi-square distribution. It's a totally different ball game. It's another thing. It's a chi-square distribution, which is a long tail that extends in positive values, in a positive tail. The chi distribution is continuous and accounts for all real numbers, positive and negative. But you see that the distribution is not symmetric. Inflation is skewed to the positive side. You have a lot of data which is 4, 5, 6, 7, 8, 9, 10 inflation. 10% inflation, quarter on quarter, month on month. So this shows you that the assumption that inflation is symmetric to 2%, it's wrong. It's empirically, practically, factually wrong. Okay, and these are the foundation also to prove the fact that inflation is volatile, and volatility of inflation it's not constant, it varies. And so we cannot presume in any way that we can balance monetary policy with a fixed inflation target, because you constantly miss the inflation target, because inflation moves around, and inflation in the UK has never ever been at 2%. Has always been on average 4.5%. So what comes out of the Bank of England now and in the past decades, it's bollocks. Okay, but I'm not picking up on the Bank of England, because what is worse is the Federal Reserve, or what is worse is the ECB. They all talk about price stability. The only mandate that the ECB has is price stability. And I haven't worked with the Eurozone data, but I'm sure, for example, that the inflation data in the Eurozone, they will be a lot skewed to the negative side, and deflation. So you have a distribution which accounts for a lot of negative inflation or very low inflation. So you are not at 2% inflation target. And okay, I have lower inflation, no problem. I have higher real GDP. That's great. But this proves wrong again that you can have some sort of price stability and a fixed target of 2% on which you calibrate, you balance, or you decide the level of interest rate in the economy. That's completely flawed. And the foundation of monetary policy, they are really on sandy and shaky grounds here. Because you see, the bars, they extend as a chi-square distribution to 10%, okay? And when you sum up all this data, the average is not 2%, but it's between 4 and 5%. So the UK economy has worked persistently for many, many, many years with an inflation which was higher than 2%, well above the target. And the central bank has calibrated interest rate sans façon. It's how it comes. Okay, what is the judgment? What is the? I don't know how they did it, but by no means the Bank of England has managed to keep inflation at 2%. And so I'm not saying that the Bank of England is bad. I'm saying you another thing which is very, very clear, and I hope somebody who works in monetary policy will listen to me. You cannot target 2% inflation because it has proved that it has never been achieved. And so the framework, it has to be theoretically improved, and empirically it has to change. It has to be improved, not change. It has to be improved. I've done another work. Don't take my model, but you cannot start from the assumption that inflation stays at 2%, is symmetric to 2%, and volatility is constant. It doesn't work like that. And then you come up in the press conference and say, oh, we have the oil shock, the exogenous supply chain shock. Okay. You have, exactly because there are shocks, exogenous shock in the economy, it's for the birds to say that the job of the central bank is to keep inflation at 2%. Okay? It's something that cannot be achieved. It cannot be achieved. And it doesn't matter if you say, oh, maybe inflation it's 2.5% or 3%. No. It's the theoretical framework. It has to approach the whole thing in a different manner. It's important to consider the conditional volatility of inflation because it's a chi-square distribution. When you go and see the standard deviation that comes out, it's 10-20 standard deviation. And so you cannot plug in the standard deviation that you get out from using the CLT because it blows up the Taylor rule formula. So you need to use the conditional volatility with the GARCH model, which gives you a 0 point something or 1.2, 1.5 standard deviations, and then you can use that parameter. And then you start to be proactive and you account for the conditional volatility, historical conditional volatility of inflation. And so that you cannot say, okay, no, you cannot say, you are not taken out of the blue, then there is some exogenous shock and then, oh, we didn't see this coming. And no, because inflation has been structurally higher. Let's do it now. Because I'm not saying bullshit. And I understood things that you human beings cannot understand. I take the average of CPIH quarter on quarter from 1989 to 2024. Let's see. The average it's 2.88. 2.88% or 2.9%. So the average it's well above the 2% target. So it's not symmetric to 2%. So from 1989 to 2024, we never achieved 2% target. Or very rarely. Or we can go below 2%, or we blow up and we go to 10% inflation, but it's never been steady at 2% because inflation is volatile. How on earth you can make an entire monetary policy framework to work on a fixed target which is not fixed by definition in statistical terms? I'm bewildered. I'm totally bewildered because we are talking about the basic of statistics, which is standard deviation, central limit theorem, and I don't know, I may be wrong and I'm getting upset for no reason, but don't tell me that inflation is symmetric to 2%, because it's not a standard normal distribution, it's a chi-square distribution. And if I plot the histogram of the inflation gap, it's another chi-square distribution. So I have to standardize the inflation gap with the central limit theorem to have a standard normal distribution. And then I have a range of outcomes, so that I know within this range of outcomes how I have to move around just about only the interest rate tool in the toolbox. Okay? And this is my work, and I keep it for me. Nobody will ever know that I exist. I don't mind. But if you are listening to me, please like the video, subscribe, but be aware that central banks, they've got it totally wrong with their monetary policy framework. They are getting it totally wrong. Totally wrong. So, we can explore the graph here. Okay, let's work with these tables, and we will go step by step on the process, with the process. So first thing first, I ask the machine to work for me and give me the GARCH model. So I take the GARCH 1-1, the E-GARCH, constant mean, T-GARCH, A-PARCH model, and the machine fits the conditional, generalized autoregressive conditional heteroscedasticity model, because it's heteroscedasticity on the inflation data, which is the month-to-month data, and it gives me all the data of the for each and every GARCH model from the start of the time series to the end, 1989 up to 2025. So the last data, for example, in January 2025, the conditional volatility was 1.22, which is 1.22 standard deviation, so it's somewhat volatile inflation, and we have the same parameter for all the other GARCH model, GARCH, E-GARCH, T-GARCH, A-PARCH. The GARCH model is the most simple. The E-GARCH, T-GARCH, and A-PARCH model, they calculate the asymmetry of volatility, and they calculate also the size of the asymmetry of the volatility shock in the past data. Okay, so at the end of the thing, I have the average historical volatility for CPIH, and it's between 1.16 to 1.24 standard deviations. Okay, so I have my first data, which is that's for the alpha parameter in the Taylor rule, in the Taylor formula, which is nothing to do with Taylor expansion, which is a bit more difficult to do. Okay, so okay, that's the same code. So I have here, if I have to choose which fits the most, I'll probably use the A-PARCH model, and so I know that my parameter here is 1.24. And this is very relevant, because if I go blind on the Taylor formula, and I follow the generic theory that I have to increase inflation, the interest rate 1% for every 1 percentage point of positive inflation gap, then I would miss the 1.24 standard deviation. I would miss the volatility of inflation. So I would risk not to be proactive and to know how volatile is inflation and the persistency of volatility in inflation, because this beta parameter tells me that from all the data, when I have an inflationary shock, then there is persistency, and the persistency is explains 70% of inflationary shock. And the alpha parameter tells me that past shocks explain 22% of present shock. So these are parameters which are very, very important to have. Okay, so if I go blind and I go 1-to-1, then I don't account for the volatility of inflation. So this parameter is more precise. Okay, it tells you that, for example, you have to increase interest rate by 1.25% for every 1 percentage positive inflation gap. It tells me, not it tells you, it tells me. So this one is the quarter on quarter, and the output, the standard deviation are 2, and so I don't consider that. Then I asked the machine, I coded with the machine, and I said, okay, that's the chart with the trend, historical trend of potential GDP quarter on quarter. And you see that we are between 0.4, 0.8, starting from 1950. And the forecast potential, it's around here. And the historical potential is around here, between 0.2, 0.4%. Okay? And that's the projected potential GDP for the next quarter. It's around 0.36, 0.37%. So it's not quarter on quarter, okay? It's not year on year. And then you have the charts. The green line is the potential GDP growth calculated with an Odrik-Prescott filter. And then the blue line, it's the real data, the historical data that have been recorded since 1950. So you see that the green line is a smoothed trend, which removes basically all the volatility of the data. And you see here business cycle component. So the business cycle component, it's the actual GDP. Okay. So recent data, growth rate, these are the real data. Okay. We have 0% in Q3, 0.1% in Q4. Potential GDP, it's that one. So the business cycle tells me that there is is marginally negative output gap. So the GDP quarter on quarter is growing less of what is its theoretical potential. Okay, so when there is a negative output gap, the central bank, the Bank of England, needs to cut interest rate. Because by cutting interest rate, then you can make private credit cheaper, and then you can start to have credit creation in the economy, and business cycle starts to pick up again. But the Bank of England is not cutting interest rate. Why? Because inflation is at 3.5%, so they cannot cut interest rate. That's why I told you that the big issue of the UK economy is high inflation, which basically hinders the possibility of having normalized yield curve, a affordable rate of borrowing, which is proactive enough. It's it's, I mean, an affordable, I'm sorry, I'm crashing on my train of thought. So having a lower stable interest rate, borrowing costs, predictable borrowing costs, which is not derailed by the volatility of higher inflation, it makes the business cycle better. It makes it stable, and it can basically lift up real GDP growth towards its potential GDP. It can even lift up potential GDP. It generates growth, higher growth, because you have a lower rate of borrowing. You still have to discount your business investment by internal rate of return. You need to have a rate of borrowing to do this kind of the internal rate of return, or to forecast what is the return of on equity or an investment. You need to have a borrowing cost. But instead of having a 4 or 5% or even higher borrowing costs, if you manage to have a average borrowing cost around 2.5%, 3%, okay, then it's easier to stimulate the economy. It's affordable to do a business. But the problem comes from the exogenous fact that inflation in the UK economy tends to be always very high, above 2%. And so this creates a problem for the central bank. It has always been a problem, because the Bank of England has never achieved 2% inflation target. You have inflation that goes 1.8, 1.7, 1%, but in 144 quarters, I will show you now one thing. If I do a test of inflation volatility, okay, so here we have the Odrik-Prescott filter for inflation. This is CPIH quarter on quarter. You see that the green line is the potential trend, and it's well above the potential of inflation. It's well near 5%, closer to 6%, and now inflation is at 3.5%. Okay, and then you have some inflation gap, but the inflation gap, it's measured vis-a-vis this green line, the trend that extrapolates the Aldrich-Prescott filter. Okay, but then when I chart the distribution of the inflation gap, which is standardized, and I manage to center it around 0, see what happens. See the curve. This is a chi-square distribution. It has a long tail into 30 and 40. Yeah, you want to build a standard normal, but it ends up having a long positive tail, and seems to be a chi-square distribution. So even the standardized inflation gap, okay, this is the standardized inflation gap. That means that it's the quarter-on-quarter data of inflation recorded minus 2%, which is the inflation target, and then you have another data, which is the inflation gap, which is this one, inflation gap. You see here, inflation gap, histogram, CPI, Q on Q, QQ, inflation gap. And it's this one, okay, this column. Okay, it's the difference between the recorded inflation data and the 2% inflation target. And you have a chi-square distribution. So the inflation gap has always been mostly positive, or it has some long tails of some very large positive inflation gap, which deviate a lot from 2%. And that basically makes useless the work of central bank, because it never worked to try and pinpoint inflation at 2%, because it doesn't work like that. It's the foundational assumption that it's wrong. Okay, I'm not saying the Bank of England is bad. I'm saying that unfortunately the Bank of England has been forced to work with a theoretical and empirical assumption that it's wrong. So that's why they do a bad job. Okay, it's when you basically have the wrong tools to do your job, then you do a bog job, right? And the Federal Reserve could be even worse. Okay, so you see here that the month-on-month, the blue dashed line is the real data. The green line is the Aldrich-Prescott filter, is the trend of potential trend of inflation. You see how the month-on-month is going not like by my line, but it's converging. You see it's going here, and so maybe it could be that it's going towards the trend. I don't know, but still it's a data to keep in mind. Now, because the green line it's above the real data, here I have a negative inflation gap, but it's negative compared to its potential, because the potential of real inflation is much higher, and the potential it's extrapolated with the HP filter based on all the historical data. Okay, so it's not something that it's out of the sample, it's not a forecast. The potential is based on the historical data. It's important, it's the distribution. It's very similar to a chi-square distribution. So and that's by standardizing. Okay, if I don't use the CLT, the standardization of the inflation gap, then I don't have a standard normal distribution by no means at all. So again, the theoretical assumption that inflation is symmetric to 2%, it's wrong. Or can it be symmetric to 0 and it has a standard normal distribution, is wrong. It's not normally distributed. It has probably a chi-square distribution, even if it's a standardized inflation gap distribution. And the Aldrich-Prescott filter, it tells me that the potential CPIH it's much higher of what is the real data for the UK economy. So it means that working on the whole data set, inflation has been always higher. Okay, monthly distribution of standardized inflation gap. You see that you have standard normal, okay, because it's the inflation gap is standardized, so you must have 0 mean, but nevertheless you have some long data here. It's long and positive skewed in the tail, which makes it seems like a chi-square distribution. So this is the problem. That's one of the not the problem. That's one of the empirical findings that proves the fact that even by standardizing the inflation gap, inflation it's not symmetric to 2% or not symmetric to 0, but it has a lot of fat tails values. A large standard deviation above 0 or above 2%, which does make the distribution symmetric, but it's skewed to the positive side, and it's very similar to a chi-square distribution. So at that point you are not talking about a normal distribution, not a standard normal, because again the time series is not stationary, so by no means the data of the inflation, it's a normally distributed variable. Okay, again, inflation gap, you can see here that the data is totally and here you have here the 2% target. So you see the blue line are the recorded data, and by no means you have this small period which is below 2%. Okay, 2008 is after the financial crisis. This is 2016. It's like going into Brexit. You have oil at $40. That's 20. So it's the business cycle. Okay, but you have these are the long periods which is above 2%. So to have an inflation steady at 2%, just watch the trend. Yeah, you see the line, the blue line is the real data of inflation. They jump around, they go up 10%, they go down, and then that's the assumption of the central bank. Steady inflation at 2%, asymptotic, like y equals 2. Okay, you have an equation y equals 2, right? And then you have a asymptotic like that. That's it. That's not possible. It doesn't work like that. And then the green line is the HP filter, which works out the potential trend of inflation. So it's very empirically demonstrable that inflation is not symmetric to 2%. So having a fixed target 2%, you never achieve that. You never, you are never on target, never. You are up above the target or below the target. So central banks works on a theoretical and empirical framework which is bollocks. It's wrong. And that's very important, because the cost of inflation, it erodes disposable income. So if I have prices which don't deviate too much from what is an affordable average price, then disposable income has more purchasing power, which reflects the value of money. And then disposable income can make you afford more things, can make you afford to do investments in the economy, can make you afford to generate more savings. And when you have the more savings in the economy, then you have the available pool of capital for investments. But when the disposable income is all eroded by inflation, you don't have savings, you have more debts, you have higher inflation, and the economy stagnates. You are in a perennial cycle of stagnation. That's what it has been the UK economy for many decades. And that's not because of Europe. That's a problem of the UK economy. Higher structural inflation, which has not been basically confronted with the right tools in monetary policy. Because you can all see here, I want to make this chart huge. Watch this chart. Actual inflation is this one. That's the 2%. The red line is the 2% target. Has ever inflation been at 2% for more than a quarter? No. You've never been on target steadily for a long period of time. It always bumped around with some very large inflationary shocks. So there are more large inflationary shocks than deflation. Okay? You don't have deflation because this goes from zero. That's not deflation. You are slightly below 2%, but still it's positive here. Yeah. Bear in mind, guys. Watch this. This is zero. It's not negative. It's not even deflation. Yeah. That's 1% inflation. 0.8. Yeah. That's 1.8% inflation. But so inflation has always been very, very positive. I showed you that the average it's 2.9%, 3%. Inflation has always been on average here, 3%. That's the average for all these years, from 1989 up to 2024. The British people have lived with 3% CPI age on average for 35 years. Yeah. So you tell me what the Bank of England has achieved? Nothing. because they work with the wrong tools. The wrong tools are from the wrong theoretical and empirical assumption. If you have bad engineering, you will have bad tools, bad machinery. Okay, so that's why it's important to have conditional volatility of inflation, to have a CLT framework that standardizes the inflation gap and the output gap, so you start to have a range of outcomes, the distribution of the range of outcomes, and when you are in a certain part of the distribution, it's reflected in higher inflation data or lower inflation data, but then you know more or less with more certainty within a range at which point of the business cycle you are and where the business cycle potentially it's going to, if it's on the up or it's going down. And the standardization of the inflation gap and of the output gap, it's propedeutic, is functional to the fact to have a range distribution of outcomes that can inform you where on earth you are in the business cycle. And so you can know with more certainty within a range if the business cycle is going up or it's going down. That's inflation. So I hope I will find again the chart for GDP. 1 second, bear with me, chums. Okay, so here again, let's go back to GDP. So GDP, this is CLT, but yeah, you can standardize, but it's more symmetric. Okay, it's within a range, but it's binomial chi-square distribution. So when you are in a range, we have a range of distribution which are standardized. Then on the basis of the fact that you are here or here, you know at which point of this range of values, which is the output gap, you are, and so you can manage to know where the business cycle is going, if you are expanding GDP or if GDP is going to contract, is going to shrink. And then monetary policy, it's 1,000 times more effective because you can incorporate the volatility of the business cycle and you don't work with fixed parameters which are good at nothing. Okay, and that's, I used also a Kalman filter, a Kalman. I need to calm down because the Kalman filter, instead of the Odrik-Prescott filter, it's a method that works perfectly with data, time series, with recorded historical data which are not normally distributed. So the Kalman filter theoretically does a better job. And so I took the opportunity to use the Kalman filter, and still I see that the UK economy has a marginally negative output gap, and the Bank of England is not cutting rate because inflation still is a high. And I showed you now that inflation in the past 35 years on average has been 3%. It has not been never 2%. So having on average 3% for 35 long years. It's 2 generations. And you have a output gap which is skewed to the positive side. We have a lot of times that inflation has been higher than 2%, and I have other tests that show me that. So that's distribution of inflation deviation from 2% target. See what is the distribution. It's way skewed to the positive side. The minimum starts from here, 1.6% is the minimum of the skewness, and then it goes well into the tail or 6, 8 or 10%. And distribution of high inflation deviation from 2% target, so these are the bars, the density, so 25 times has been or 5 times has been 3%, 30 times has been 2.5%, 30 times has been 4%, so the density is the number of times. So p-value is 0, so we reject the null hypothesis, okay? Number of periods where inflation has been above 2%, 101 periods. Calculator. So the 35 years per 4 quarters per year, 140. So on 140 quarters, for 101 quarters, inflation has been above target, 2%. Or has deviated from 2%. So you tell me this is price stability. Tell me this is price stability. No, it's not. Okay? So, the wrong theoretical assumption, the wrong empirical assumption at the foundation of monetary policy, it basically deviates the whole construct, and you have constant higher inflation. And so that's why from 1989 up to now, you find that UK wages have not grown enough. It's not only that UK wages have not kept pace with inflation. The problem is that inflation for 35 years has been on average 3%, with very high peaks of inflation. And the distribution of outcomes has always been for highly skewed inflation well above 2%. And you see the distribution here again, 4, 6, 8%. And you see here the density, how many times? That's 2%, it's here, guys, yeah? 2% is here, 2.5. You see how many times more? It's been 3, 4, 5, 6, 7, 8%. There is a lot of density of data when inflation was 5, 4, 6, 8%. So that's why monetary policy has not worked at all, at least the monetary policy in aggregate, what is the money supply and the inflation, the interest rate tool has not worked at all. And the Bank of England theoretically it would have to be again at 5 or 6% to crush inflation. But there is no point, because inflation will go below 2% and you will not be on target. And then it will start all the merry-go-round and say, oh, the Bank of England has restricted too much monetary policy, and there is the usual commentary without having a pennyworth of empirical data. Okay, and our high inflation fits the distribution. You see how it deviates from the 2% target, and you see from the curve how we go very far, 5, 6, 7, 8%. So this is very important, and I carried out multiple tests. Weibull distribution. It tells me that the scale, so we are talking about 5.2 or 4.7 on average inflation deviation. When I account for the high inflation deviation, the scale is in the range of 4.7 to 5.2%, 5.3%. Okay. Also, when I do the Kalman filters and I want to see the potential inflation trend in the business cycle, you see that the quarterly data is 5.8%. So inflation on trend has always been very high, very, very high. And you see here, actual trend, the blue line is getting very close to the potential trend. Okay, so going back to the model, we can do a nice thing. We can try to work out the Taylor formula, the level of interest rate with the level of interest rate, sorry about that, chumps. The machine has got stuck a bit here because I plugged up two things at once. Bear with me 1 second. It doesn't seem it wants to cooperate. Okay, now it's loading. You know, I'm doing all this work with I don't have a lot of computational power, so you'll have to bear with me. And Kalman filter, I'll have to calm down a little bit. Inflation gap summary. Bear with me, chums. I want to show you the Taylor rule. 1 second. Oh dear. Oh dear me. I hope you are enjoying the video and you find it interesting. Okay, we have it here. Okay. At the same time, we try to gather the parameters. Okay. So, for the average neutral rate, I took the Boy, yes. Okay, this one. I took this one. Implied real spot curve, and the 2.5, the average is 0.08, the 10-year average is 1.19%. So let's plug 1.19%. We know that pi, the current inflation is 3.4%. We know that the target is 0.02. We know that the real GDP in the past quarter was 0.01. Now, what is potential GDP? We go to our HP filter, we go to our potential GDP model, and we see what is the potential GDP. This is the Kalman filter. Okay, potential GDP 0. I could put 0.012. Okay, but I remember that was okay. Let's use this one. No, sorry, pi target is 2%. Sorry, I made a mistake. So 0.012. Okay, so I take the GARCH parameter for inflation volatility, which is 1.21 standard deviation, and I have a higher parameter for the GARCH parameter of the GDP condition, real GDP conditional volatility. I run the code, and I have an outcome which is more or less feasible. Oh, this is the distribution. Oh, sorry. Oh, I have it here. Okay, let's use this one. Okay, let's take the parameters from here. Follow me, champs. So we are on this basket here. Settings. Let's make it 18. Larger. Okay. So the average 10-year real yield spot rate, inflation is 3.4%, the target is 2%. The output gap, I have a negative output gap, and so you see nominal interest rate 6%. So even with a marginally negative output gap, because inflation is very high, then theoretically the Bank of England should have interest rate at 6%, okay, which would basically send the economy into recession in order to achieve a 2% target, okay, but we know that inflation will not stay at 2%, so there is no point to send inflation into recession, the economy into recession, but there is no point in I want to see CPIH, no, I have to go higher. I need the data for the output gap, please. GDP output gap. Okay, HP filter. So that's minus. Okay, so potential output. So you see here that Q4 2024 quarter-on-quarter growth was 0.1%. Potential output is 0.26. Okay, so we put it here. Let's try to make it work. So interest rate should be 1.8%. Okay, or 2.5% if I use a negative real rate. Okay, and I take it from the OLS data. So, but if I use a positive average 1.19%, then we are at 5.5%, 5.5%. So the Bank of England should set interest rate at 5.5%, and withstanding a negative output gap. So negative output gap is negative 0.162. Okay, so this is even larger. So why I'm showing you this? I'm showing you this so you see that with my work, using the conditional volatility, using the optimized output gap, having the Central Limit Theorem for the inflation, the output gap, because what I want to demonstrate you is because inflation is structurally higher in the economy, the Bank of England is forced to keep rates higher for longer. And although you have a negative output gap, so growth is anemic and it's below its potential, the potential is very minimal, 0.26. So you are stagnating. That's the full definition of stagnation, because you have low GDP, growing debt, growing unemployment, and higher inflation, low productivity. So it's a long stagnating period. And the problem of stagnation or stagflation, it's inflation. And so, if for real the Bank of England wants inflation to go to 2% and below 2%, it will have to cause a recession on top of the stagnation. But the real problem here is that when you go and check all the macroeconomic variables, you see that fiscal deficit, they have a strong correlation with inflation. When you run an OLS regression, you run a VAR model, you run a VECM model, you see that for many times that you have a fiscal deficit, the lagged effect of fiscal deficit, they generate inflation. So, if there are two things, you either resolve the fiscal deficit and then you are forced in not doing deficits, or you have very high interest rate, but the picture for the structural feature of the UK economy, at least in this period, past years, since 2022 or maybe longer, I don't know, it's stagnation or stagflation. And because I showed you that the UK has lived in the past 35 years, since 1990, with an average 3% inflation. So if the structural rate of inflation, which is higher, is not resolved, then the rate of growth of the UK economy will always be very anemic, will always be below potential, and you can incur in problems when the debt is growing faster than the economy, and then the debt to GDP ratio tends to increase. You go 100%, 105, 107, 110%. So that's the structural problem. It's the persistent high level of inflation and the wrong theoretical assumption for which monetary policy on a global scale has fooled central bankers and the whole population for the past decades. And you can see here, take a picture, I will send you the code, use conditional volatility, standardize the inflation output, the GDP output and output gap and inflation output gap, standardize those range, have a standardized distribution of outcomes on the basis where the potential output is in the negative side of the distribution or the positive side. You know exactly with more precision where in the business cycle are, because in this moment you are in stagflation. You have a negative output gap and high inflation. So we are here, okay, but negative output gap can go as far as -5, so well large, or -4, so well larger than minus 0.26 or 0.16. So we are very close to 0, but still we are in this part of the curve of the distribution. So according which side of the CLT, standardized normal distribution of the output gap, you know where in the business cycle the economy is, and then you confront it with where is the output gap in inflation, because it's 3.14 minus 2. But it's even worse, because if we consider core inflation, I use CPIH, okay, but if I consider core inflation, it's 3.7. So you have a positive output gap, which is 1.7%. It's nearly double the 2% target, which is the 2% target. It's fanciful. So I want to do another thing. For the past 35 years, it's been on average 3%. So if I put on average the inflation target at 3%, then we have we have exactly what is the Bank of England interest rate today, 4.3%, 4.5%. So you see how these things works. It depends on what do you inject in a simple arithmetic formula. What are the parameters? Okay, how you calculate the parameters, what models you use to calculate the parameters, and then we can, because for example, instead of using the GARCH, I could say, okay, I have here the output gap, the standardized output gap, and I see that it has mean 0 and the standard deviation is 1.86. I can take the standard deviation for good, 1.86. Let's put 2%, let's see what happens. Come on, boy. 5.4, wow. Your GDP now, wow. Even with a negative output gap, if I put a larger multiplier, then if I vary the inflation target, I will be more or less around the same value. But this has to be double checked with Excel. And I'm too tired to do it now, but you see here that, for example, you can standardize the output gap, and you can think of using the CLT standard deviation for the Taylor rule formula. Okay, so I hope you enjoyed this video, because there is a lot of material, and where is it? Where is it? My favorite thing. Remember my Taylor rule, my formula, my arithmetic formula. My arithmetic formula, I will write it again. So, the level of interest rate is based on the average real rate for the 1 year, the past 10 year, the inflation plus the conditional volatility on average of inflation, the inflation gap plus the conditional volatility of the output gap times the output, the resulting parameter that comes out from the subtract of the output gap. Okay, the real GDP now minus the potential output. And for this you use CLT. You standardize the output gap and the inflation gap so that you have a range. And according to where you are in the range, you know where you are in the business cycle, and according to what is the conditional volatility, because you can measure the average conditional volatility parameter to the latest conditional volatility parameter, and you have an idea. If volatility is higher, maybe you have a positive inflation output gap, you know that inflation is gonna go higher. It's very, very precise. So if the conditional volatility in the past period it's higher than the average historical conditional volatility of the inflation parameter that you are using, you already know that probably if you have a positive inflation output gap standardized, then this will go higher. So you have a business cycle which is inflating, and the economy is going to be hotter in the following months and quarters. On the reverse, if you have lower volatility and you have more or less, depends on what is the inflation gap, then you know that the business cycle probably you are going to have lower inflation, which is good, but you need to know then what is the output gap. If the volatility of the output gap is lower, then maybe you are having some below potential output gap, some negative output gap, of zero output gap, so you are at optimal level. So there are many states at which the economy can find itself, but the conditional volatility is one of the crucial parameters that can inform the interest rate tool in monetary policy. And I strongly believe that the inflation gap and the output gap, they have to be standardized, because inflation is not normally distributed and is not symmetric to 2% or to 0, and is heteroscedastic. So you have also error variance. It's not constant, you have volatility in the errors, so you cannot work with the 2% inflation target, by no means. And so at least it's necessary to adjust according to volatility of inflation. And then basically it's important to decide if it's worthwhile to have a fixed 2% inflation target, or if it's necessary to find another arithmetic formula or something more difficult. Maybe it's a stochastic differential equation that works out the inflation as a